I really don't care what Abercrombie and Fitch thinks.
It's not that big of a deal. It's one ratings agency.
This is not very much more complicated than sell the news. You had a huge run up into this earnings season. We're in the middle of it. We're on track to see a 7% decline in earnings for the S&P 500, which was the expectation for this quarter. We've had 51% of S&P companies report earnings, and you have 80% of these companies beating on earnings, which is the highest number we've seen in 7 quarters. So you're getting those good results. That was the reason for this huge rally we've had since May. You're seeing companies with decelerating revenue growth still finding a way to beat on margins with that earnings beat. So I think on balance, like, we're getting the justification for the rally we've already had. We're not really getting a justification for further gains from here. Look at the reaction in stocks after they report. The companies missing numbers are doing better on average the next day than the companies beating. We've had a lot of the run up and we're just getting the news that people are selling on. I think it's a better take than, something's materially changed, because we're still in an uptrend.
We got comfortable that our companies are going to make their numbers. The economy seems like it's far away from recession.
Higher rates actually have acted as economic stimulus. The people who own 80% of the stock market, upper middle class, and you don't have floating rate debt, which most people don't, it's very likely if you were carrying a mortgage, you refinanced that during the 24 months where it was basically 2 or 3% to do so. If you're in that situation and you have cash, if you're not facing a situation where Fed funds affect you negatively, and again, upper middle class, they don't carry credit card balances, what do you think they're doing right now? This is why you're not getting that economic slowdown. This is exactly what's happening that really was hard to foresee in advance. If you talk to old timers who were rich in the early 80s, they'll tell you it was the same thing. They didn't have credit card debt and they weren't looking to buy a house with a new mortgage. They loved 15% interest rates. They couldn't count all the money they were making. And for those people, you're not getting any kind of a slowdown in their consumption. And if anything, you're getting a double wealth effect, stocks and yields.
We knew that debt was high. We knew that we had continued to create debt in order to cover everything that we've done and stimulate the economy and sort of save us from disaster a la March of this year. So I don't think that this is a huge surprise. The reason for the downgrade, it's not that big of a deal. It's one ratings agency. It's one little step downward. It probably goes back up decently soon. I think actually the bigger risk right now, which we knew when the debt ceiling issue happened, was that we just kind of kicked that down the road. We got through summer and then it was going to come back up again in September, October. We have not entirely resolved that issue. Eyes on September, October for that. I don't think this is the last daily pullback that we're going to see in August. But again, I think it's healthy. The question that remains, and that continues to be further and further away, at least for me, is will this be the beginning of a deeper pullback? Will this be something that gets added on to with credit issues or something that could happen in fall and surprise us from the Fed?
The 20 best performing stocks in the S&P 500 this year have gains on average of 83%, and that's an average. So a lot of these things have more than doubled. That's your top 20 stocks. Go down the list. 8 of them are tech, 6 are consumer discretionary, 3 industrials, 2 healthcare, 1 communication. It's pretty broad-based. If you think about an inside-out day, it's like all counter-trend stuff going on. Those stocks, those top 20 names of the year, they're down today on average 3%, way worse than the overall market. If you've been locked out of this market because it's been trending and you just can't think straight and you're watching it tick up day after day after day, this is what you want to have happen. I think this is a situation where you want to look for opportunities to get long. You want to see stocks pull back. If you want to use a moving average as kind of a gauge where they should pull back to, where the buyers step in, that's fine. I don't have a problem with that. We'll get through earnings here. And then we'll be basically facing a situation where we've had the trough quarter. We're not expected to decline another 7% in earnings next quarter. The trough is here. And I think people will go into the end of the year feeling positive about that, not knowing where earnings will trend, but probably not down.